Hello, and thanks for joining us today for our investment update that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. Now, today's update's going to be a bit more comprehensive than usual given the recent downside market action that we've seen. So let's start with the market itself. Here we're showing year-to-date returns, and we can see that domestic large cap stocks are now down over 13% on the year. Small caps have been an underperformer, down about 18%. Now, international markets and bonds, those have both been useful portfolio diversifiers thus far, and that's really been our theme of the year is portfolio diversification. So let's start with what's been primarily driving the correction, and that's really been policy uncertainty. So here on the left, we're showing the market spike in uncertainty itself. Now, the good news is that prior periods of extreme uncertainty, those have eventually seen the market begin to recover. Now, the chart on the right shows forward returns after varying levels of uncertainty. And today's uncertainty is on par with these red bars in the chart. Now, on average, the market has returned about 22% the following year after such a large spike in uncertainty. Now, that doesn't mean that the correction is over, but it does mean that the forward outlook is likely one of market recovery. So let's try to put the tariff policy in some context. This chart shows the blended tariff rate with last week's proposals. It takes US tariffs up to a little over 20%. The tariffs are projected to raise about 600 billion in revenue. Now, the administration was targeting about 6 trillion over 10 years. So these tariffs are in line with their stated goals. Now, one of the key reasons that the market reaction has been so negative is that the tariffs are equivalent to the largest corporate tax hike in history, totaling about 1.6% of GDP. Now, this can be somewhat offset by a further corporate tax cut, and the timing of that would likely be very important. And to put it into further context, total corporate tax receipts today are a little over 500 billion. So compare that to the 600 billion in tariff revenue that's projected. Tariffs are a greater impact than the entirety of corporate taxes paid today. The longer that the tariffs remain in place without an offset from easier fiscal policy or even less restrictive Fed policy, the greater the risk to the broad economy. Now, this chart is showing sales and earnings growth in the first two clips in blue and black, and then it's showing profit margins for the median company in the S&P 500. Note that growth has already been sluggish for the median company, with sales growing 3.8% and earnings growing about 5%. Now, margins have been climbing, and that's helped corporate fundamentals. But trade policy presents a risk in the form of both slower sales growth and a negative hit to those profit margins. Now, we've already observed a pretty steep drop in consumer confidence. This chart here shows consumer confidence in red, and in blue is the change in the unemployment rate. That index is inverted, so if the blue line is falling, that means that unemployment is picking up. Historically, when consumer confidence is declining, the unemployment rate also tends to climb. So this certainly has our attention today. Now, one data point that I think will be important to watch is the personal savings rate. Yes, consumers are saying that they feel pretty downtrodden right now, but thus far, they've continued to at least spend money. Now, this chart shows the personal savings rate in red, and you can see it's actually dipped, not risen. Historically, there's at least some positive relationship between unemployment, which we're showing in blue, and the savings rate. We want to see if consumers are actually beginning to alter their spending behavior, and we could see that manifest in a higher savings rate, which could become an economic headwind. Now, not all is perfect with the consumer. Real-time trackers of economic growth are in fact showing somewhat weak consumption in Q1. This one here comes from the Atlanta Fed, and it's currently forecasting that consumer expenditures will only contribute minimally to economic growth for Q1. And that's important because the consumer has been a stalwart in this expansion. Now, fortunately, the labor market data from last week emphasized that we did enter this period of trade policy uncertainty in good shape from a jobs perspective. There were 228,000 jobs created in March. Now, there were some concerning trends in the composition of the job additions, but in general, employment is holding up well. Now, as for investment strategy, we want to watch the risk of further downside and balance that with the chances of recovery. In order to become more cautious, we need to see a higher probability of an extended bear market in our indicator set. This chart is an example of something that we might look at. In the bottom clip, it's aggregating 10 different indicators that have historically had good accuracy in identifying bear market risk. When half of those indicators have agreed that bear market risk is high, the median drawdown has been 20% over 118 calendar days. Now, that 20% is in addition to whatever drawdown preceded. So, we'll watch objective indicator evidence like this here to inform our view and the risks of further downside. Now, from a macro perspective, recession is not yet our base case. Again, we need to lean on objective indicators here to make that recession call. Now, on this slide from our research partners at Ned Davis Research is 10 high conviction leading recession indicators. For now, only one is consistent with recession, and that's the Services Purchasing Managers Index. Several more are moving in the wrong direction. So, again, we want to monitor that, but we also want to remain objective. As for what to expect for the market in the near term, correction lows tend to follow a bottoming process rather than being a 1 day event. This chart shows a stylized version of how corrections tend to play out. The blue line would be a stock market index, and the orange would be an example of market breadth. In this example, a high reading on the orange line would mean that many stocks are making new lows. So, what tends to happen is you tend to get an initial flush whereby many stocks make new lows. Then the market tends to rally off of oversold conditions and extreme pessimism. Following that, the market tends to retest the old low levels, but market breadth tends to be less bad. In other words, less stocks make new lows on a successful retest, and then a rally back towards the highs does tend to ensue. For now, we're in stage one of this correction, with a few stages to go before we'll likely feel confident that this bout of volatility is behind us. Now, sentiment is certainly getting to a place where we may begin to expect a near term rally. Here, this chart is showing a composite of various investor sentiment polls. It's now consistent with pessimism that the market experiences less than 1% of the time. Historically, rallies have been strong following this sort of washed out sentiment. But again, it's probable that the initial rally attempt will not be the end of the corrective action, though that is not unprecedented. Even so, we need to remain flexible in our views. Now, in order to have confidence that the forward 12 months will be bullish, we'd want to see very strong market participation. This is a simple but effective indicator. In orange in the bottom clip, it's showing the percentage of stocks that are trading above their respective 50-day average price. Historically, when 90% of stocks meet that condition, the market has tended to gain 17 to 18% over the next 12 months. Now, streaks are meant to be broken, but encouragingly, the market has never been down in the 12 months following strong market breadth as measured by this indicator. So, we would watch indicators like this to better be able to label the all clear signal. So, just some closing thoughts here. The tariff implementation from last week has really been driving an acceleration in the correction that we were already seeing and pointing out. It could be important that fiscal and monetary policy come in soon and ease the burden of tariffs to offset, especially on from a corporate tax perspective. Beginning to see some changes here in consumer behavior, and that's a risk to the economy, though we are far from saying that the bottom has fallen out of the consumer so far. Now, recession evidence is not yet broad based, but some indicators are moving in the wrong direction, so we need to pay attention to that. As always, we want to thank you for joining us this week, and we wish you a terrific week ahead.